Welcome everybody to Safe Option Strategies presentation of the Bull Call Spread. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. So let's go ahead and define what a bull call spread is. Up to this point, if you're following the education in order, this I think is probably what you've been waiting for. We really get into the heart and soul of spread trading right here. We've talked about a couple of trades you can do, a simple covered call strategy, a simple married put strategy. We're going to get a little bit later in the presentation or in the education, we'll get into how we combine those for collar trading. And one of the two core components of Safe Option Strategies is collar trading, the other is spread trading. We are now into the spread trading strategies. The bull call spread, I believe, my opinion is it's the first spread trade you should learn because I think it's one of the easiest spread trades to understand. For most individuals, they understand calls a little bit better than they understand puts initially. And so I like to start with some call trades and some debit spreads first. All right, the bull call spread defined, it is a debit spread because even though we will use two different option instruments and we will buy one of them and we will sell one of them, the very definition of a spread trade, remember we had our introduction to spread trades in the previous class, even though we will buy one option, we will sell the other option, the net result of entering this trade is that we will buy to open the overall trade, and that means that our overall entry into the trade involves money out of our account, and that makes it a debit spread when we start the trade. The trade takes advantage of strong bullish movement following technical crossovers, and more often than not, right after an earnings report. The reason, we'll talk about this a little bit more as we move on in the class, but the reason I say most often right after an earnings report, not always, but typically, there's two reasons why we watch earnings reports as it relates to a bull call spread. Number one, earnings tends to be the biggest, most predictable catalyst for a move on a stock. Keep those two things in mind, and you've got to focus on both of them, not just one of them. The most likely and the most predictable thing to give us a big movement on a stock are the earnings. There's other things that can cause a big movement. There are other things that are likely to cause a movement, but we may not have as much visibility and predictability on those things. To structure the trade, a long call is placed at or just out of the money and typically 45 to 90 days to expiration. This is going to be our primary or money-making option. A short call is then placed one or two strike prices higher than the long call and in the same expiration date. Whether that's a weekly or a monthly option, they're going to have the same expiration date. This is our secondary or our hedging option. And our overall cost basis in the trade is whatever we pay for the long option, the long call, minus whatever credit we take in on the short call. That's our cost basis. Our cost basis is another way of saying our maximum risk. When we talk about the cost basis of being in a trade, we're talking about our maximum risk in the trade. Our maximum reward, and I'll show you how this works in a minute, is the difference between the strike prices of the two options minus the cost basis. That will represent the most amount of money we can possibly make in the trade under the best circumstances. And a good target return for this trade can be anywhere from 15 to 30%. More often than not, with a bull call spread, you're going to target 20, 25, 30% in the trade. Occasionally, you'll see an attractive bull call spread, and you'll feel good about getting out with 15%, but I think more often than not, you're going to be in that 20 to 30% range, and a lot of the bull call spreads that I structure have a 20 to 25% target return on our investment. Now remember, this target return is different than your maximum reward. A lot of bull call spreads you'll set up will have more than 100% possible return, when we target 20 to maybe 25% return, what is it we're controlling when we target a 20 to 25% return? What would be the purpose of that? We're controlling our greed, right? We're simply being less greedy, and more important, or at least as important, if not more important than controlling our greed, we're just being realistic and smart and prudent about when we should get out of a trade. Okay, a good target time in this trade is less than 6 weeks. And honestly, we're looking in a bull call spread, we are looking for strong bullish movement. We're looking for that quick pop up on the stock, a week or two of strong bullish movement. When we get into a bull call spread, the absolute best thing that could happen is we get that strong move to the upside, and we can find ourselves exiting that trade in 2 to 3 weeks. That's ideal. We need to go into the trade with the expectation that we'll be in for 6 weeks or less. And if we're in a bull call spread for anything more than 6 weeks, I guarantee you we have adjusted that trade. The only way we're ever going to be in that trade for more than 6 weeks is if we're adjusting that trade. Now, what are we looking for as far as the trend to get into a bull call spread? Well, the primary thing we're looking for as a trend is when we get 3 technical crossovers at the same time. Now, you're going to have to use your imagination. I took some screenshots that don't show us the MACD down here, but the 3 things we focus on are the RSI. You know this from our technical analysis class. The 5 and 20-day moving average. These aren't necessarily in any order of importance. And the MACD, the moving average convergence divergence. Okay, those are the 3 big technical indicators we're looking for. When we get all 3 of these, so imagine down here below our chart, we have the MACD crossing over to bullish territory. When all 3 of those things happen at the same time, that is an ideal time to get into a stock, or to get into a bull call spread, excuse me. That is an ideal time to get into a bull call spread. When that creates with it the expectation that there will be some continued strong bullish movement, that is an ideal time to get in. When we are close on these things, I didn't have to draw those on there freehand because they were coming in. When we're close on these things, we should be watching close. When we get close, this is when we're starting to calculate and say, I'm really close on the RSI. I'm looking through my watch list. I'm looking at open stocks. I'm taking a minute, or I'm looking at stocks on my watch list. I'm looking at option charts for technical analysis on these stocks. I'm looking to see what opportunity I might have for a trade. Maybe in a situation like this where I've got the RSI this close, I've got the 5 and 20-day moving average coming right together, and maybe I've already had that technical crossover on the MACD. Remember, we've said in previous classes, in technical analysis specifically, that it's not uncommon for the MACD to be what we would refer to as a leading indicator, or the one that happens just a little bit sooner. So now we're keeping a close eye, but why would we refrain from getting into a bull call spread as we're about to get these crossovers? Let's say the stock closed today giving us a technical crossover on our 5 and 20-day moving average. At the time this class is being done live, we are 7 days away from an earnings report. On July 17th, we have our corporate earnings for Netflix. We're just using Netflix as an example for this chart. Bull call rule number 1 is we do not want to be in this trade through an earnings report. If we believed we could get a run up on this stock in the next 5 days, or we were willing to simply get out, maybe we could take advantage of a bull call spread on some technical crossovers right now. In a situation like this, I would be inclined, and I would urge you to wait until you have that event. A bull call spread only profits through a bullish move on the stock. a traditional bull call spread. Now we've got an entire different class that we're going to talk about some out-of-the-box bull call spreads. But a traditional bull call spread is going to profit with a strong bullish movement. This is a directional trade. This is not a trade that takes advantage of a stagnant to slightly bullish to strong bullish movement. It doesn't take advantage of either a bullish or a bearish movement. It profits with a strong bullish move. Do you know what's going to happen on the earnings report coming up in a week? I don't. I can guess, I can hope, I can speculate, but I have no way of knowing what's going to happen on the next earnings report. Earnings reports are predictable from the standpoint of when something is going to happen, good or bad, but we should never go into an earnings report with a directional trade thinking we know which direction the company is going to move. At the time of this class being done live, we're just about a week and a half past, or maybe only a week past, an earnings report on American Outdoor Brands Corporation, and I was certain they were going to go bullish on their earnings report. And instead, they sold off almost 10% in the couple of days following their earnings report. The reason I point that out is because you simply don't know. Bull call rule number one, don't go through an earnings report with an open bull call spread. Okay? How do we set up the trade? Let's suppose the current price of our stock is at $39.32. Now, we're obviously not talking about Netflix now. That stock's trading up around $150 a share. I'm switched to a different stock because of the option chains that I'm going to bring on the screen in just a moment. Let's say currently the price of our stock is $39.32, and let's say hypothetically that we just had some bullish technical crossovers, and so we're going to go out a few months in time and we're going to grab the option that is at the $40 strike price, just out of the money. Why in a bull call spread would we typically grab the option that's just a little bit out of the money for the long call? Why pick up the long call that's just at or just out of the money? What would be the advantage to doing that? We're going to pay less for it, right? We're going to spend less money on the option that's just out of the money. If this is a debit spread, we want to spend as little money as possible to be in this trade. So we go out and get our 40 strike long call, and that's going to be our primary money-making option. That's the option that we're looking to make the money on. Then we're going to get our short call at the 45 strike. Ignore these dates down here. They're not going to match up with what I show you on the option chain in just a minute. So ignore these dates. We're going to be 45 to 90 days out. I'll talk about that in a moment. Our short call at the 45 strike is our secondary or our hedging option. As the price of the stock moves up, both of these options are going to gain value. Call options, whether they are long calls or whether they're short calls, when the stock is going up, the call options are increasing in value. Now, that's a good thing for our long calls. That's not a good thing for our short calls. Good for the long calls, bad for the short calls. The long calls have to gain value faster than the short calls for this trade to profit. And the bull call spread is one of a couple of trades we place where we need to take the time to look at the delta of the two options. I'm going to show you an example of that in just a moment. Ideally, if we've got ideal circumstances, we want the difference between the deltas. The long call delta to be 20 cents per share greater than the short call delta or more. Ideally, that's what we want the difference to be. Now, let me give some explanation on this for a moment. We get into our bull call spread. Let's say hypothetically, we're going to pay $4 a share for this long call, and we're going to take in a credit of $2 per share for this short call. So that our cost to be in the trade is going to be $2 per share. Now the stock begins to move up. We've got those technical indicators. The stock starts to take off to the upside. What is happening to the value of this long call? It's going up, right? What is happening to the value of this short call? It's going up, right? Right. I'm saying, I'm kind of asking that as a question, but I'm kind of implying the answer as well. The long call is going up in value. The short call is going up in value. Both of those things are happening. If they're increasing at the same speed, we're not making any money. If the stock moves up $1 and the long call moves up 50 cents in value and the short call moves up 50 cents in value, we haven't made anything. There's no profit being had here. Now, this is a good time to talk about this. The reason our maximum profit is the difference between these strike prices minus the total cost to be in the trade. Okay, let's stick with these numbers that we're using in an example. $4 per share money out for the long call, $2 per share money in for the short call. Actually, I'm gonna pause right here. I gotta stop myself. I've got a screen coming up where I'm gonna go over this. So I'm gonna shift gears for you. Let's continue to talk about the delta. If the long call has a 0.55 delta and the short call has a 0.35 delta, what's the difference between those? 0.20, right? What this means, for those of you that might not be as familiar with the Greeks and as familiar with what the delta is, we had a class previously where we talked about the Greeks briefly. I didn't spend a lot of time on them because we don't use the Greeks a lot in our trading strategies. But here we are using the Greeks in one of the first strategies we're teaching you. A 0.55 delta on this long call means that for every dollar that the stock moves up in value, this long call should move up approximately 55 cents in value. That's what a 0.55 delta means. So if my stock goes from $39.32 a share to $40.32 a share, my $4 long call should be worth then $4.55. If I have a 0.35 delta on my short call and my stock goes from $39.32 to $40.32, and I took in a credit of, this was $2 a share, this goes up $1, this should go up to $2.35 a share. Now what has happened? If I can sell my long call now for $4.55, that's a 55 cent per share profit from where I bought my long call. If I have to pay $2.35 to close my short call, I've lost 35 cents closing this. And the net result is I've made 20 cents per share profit. Not 20%, I've made 20 cents. If my cost to be in the trade was $2 a share, I just made 10% profit. One of the reasons this is so important, is because I've got to figure out if I want to make a 20% profit in this trade, I need to know approximately how far up does this stock have to move for me to make 20%. If I'm going to make 20 cents on every dollar move up, approximately. If I'm going to make 20 cents on every dollar move up, I need to know that this stock is going to move or have a good indication that this stock can move a couple dollars up in value for me to make the money I want to make on this. Here's what the trade would look like if we were to open it on a current option chain. And by the way, this is an option chain right now for First Solar. Okay, we're going to buy to open the 40 strike call for $2.78. We're going to sell to open the 45 strike call for $1.14. This is our bid price column. This is our ask price column. When you are making the determination on whether this is a good trade, do you have to resolve to the idea that you're going to pay $2.78 for this long call? No. You might get a fill order that's closer to the bid price than the ask price, or you might end up somewhere in between. But to determine if it's a good trade or not, start off by making the assumption, start off with the assumption that you're going to have to pay the higher price for whatever option you're paying for, and that you're going to take in a credit of the lower price on whatever option you're selling. And if those numbers come out good, you know it's a good trade. So $2.75 money out, $1.14 money in, and we have a net debit of $1.64 per share. That is our cost basis. That is our maximum risk in the trade. That's the most amount of money we can lose in this trade. Okay, our net debit is equal to our maximum risk, which is equal to our cost basis. Now, the maximum reward, the most, I knew I had this on another screen. That's why I stopped when I was going over this before. The most money we could make is the difference between our strike prices minus the total we paid to be in the trade. Okay, let's look at that in detail. We're going to look at our theoretical break even and our maximum profit. To figure out what your theoretical break even is, figure out the debit of your trade and add that to the strike price of your long call. That's your theoretical break even point. Think about it this way. If it's going to cost us $1.64 per share to be in this trade and our long call is at a $40 strike, once the stock has gone up to $41.64, we can no longer lose money in that trade. Now, this theoretical break even, let me give you a definition of theoretical break even because I don't think I've done that before. A theoretical break even point is where you would be guaranteed to not lose money at the expiration of your options. The dollar value of the stock at the expiration of your options where you would be guaranteed to not lose money. I'll say that one more time because I had a hard time spitting it out coherently the first time. At the expiration date of your options, the dollar value of the stock where you would be guaranteed to not lose money. That is your theoretical break even. Here's the reason why. The example we gave on the other page had September 17 options. That means they expire on the third Friday of the month of September. If we open this trade today and we stayed in this trade until the day the options expire, and on expiration Friday, First Solar finishes at $41.64. Okay, what is the value of our 45 strike short call at that day of expiration when the markets close? How much value is in a 45 strike short call if the stock just finished? I need a one in there. If the stock just finished at $41.64, what is the value of a 45 strike long call? It is worth zero, right? It is worth absolutely nothing. If it's not in the money at expiration, there is no value in it. Now that's good for a short call, right? We took in $1.14 on this short call. So that $1.14, 100% of that right now, 100% of that is ours. We never have to give it back. We never have to do anything with it. Our broker's not tying it up or holding it. It's 100% ours at this point in time. We paid $2.78 for our long call. And at the day of expiration, at the hour and minute and second of expiration, when the September 17 options expire, how much is the 40 strike price long call worth if the stock price finishes at $41.64? Well, it's $1.64 in the money. It has to be worth at least $1.64. It has to be worth that because at expiration, we have the right to go out and buy stock at 40 and we can sell it at that moment for $1.64. We're going to make $1.64 on that long option. So if our total cost to be in this trade If the $2.78 we paid for our long call minus the $1.14 we took in for our short call equals $1.64, as long as the stock is worth $41.64 at the day of expiration, we will break even. Our maximum profit is the difference between our strike prices minus the debit, the net debit. Okay, what's the difference in our strike prices? $5, right? Difference in our strike prices is $5. We spent $1.64 to be in this trade. What's the maximum amount of money we could lose? $5 minus $1.64 equals $3.36. That's the most amount of money we could make. Because if we got to expiration, go back to your expiration, or any day before expiration, if we got all the way to the expiration date or any day before expiration, and we got called out at 45, the stock has to be above 45 for us to get called out at 45, right? No one is going to call us out at 45 when the stock is trading at $42 a share. It's not going to happen. We will get called out if the stock is above $45 a share and we're close to earnings or at earnings. If we get called out, what is our obligation when we get called out on a $45 strike price short call? We now have the obligation to sell stock at $45 a share. That's fantastic if we can buy it at 40, because we're guaranteed to make $5 profit on that transaction. But it cost us $1.64 to be in that position where we could do that. So our profit after all that is $3.36. That's how we calculate our maximum profit. And in this case, and I know some of you, you might not be able to see this on the bottom of your screen, that's a 205% profit. Now, if we could make 205% profit, why in the world would we only target 20 or 25%? Because we have no guarantee that the stock will go above $45 a share and stay there long enough for us to get called out. And the longer we wait for that possibility, the greater the chances that the stock turns and goes back below 40. And if it goes back below 40, we're at risk of losing 100% of it without an adjustment. See how all this is working? Okay, here's an example of the deltas. Every time I do this class live and I re-record it, I always think when it's too late, I should have put this slide ahead of the one that I just showed you when I'm talking more about the deltas. And I always forget to do it. So we're going back and recapping now on the deltas. The delta for our 40 strike, September 40 strike long call, it's kind of faded there, but you can see it. The delta is 51. That means that for every dollar the stock goes up in value, the 40 strike long call should go up 51 cents. And for every dollar the stock goes up in value, the 45 strike short call should go up about 28 cents. And the difference in the deltas in this case is 23 cents per share. So let's go back to our other example. Let's go back to our real numbers. We came up with $1.64 per share cost basis. That's our cost to be in the trade. And we know that for every dollar the stock goes up in value, we should be seeing a profit of approximately 23 cents. How far does this stock need to go for us to make a 20% profit? If we've got $1.64 investment times a 20% profit, we need to see about a 33 cent per share profit for it to equal 20% of our investment. Well, if we might get 23 cents per share with a dollar movement up, we may only need about $1.50 movement up to get that profit. Now, odds are we're going to need a little bit more than that. We're going to want to cover our commission. Probably we'd want to see this go up closer to 40 cents profit so that we make our 20% after covering some commissions that we're going to pay to open the trade and to close the trade. That would just make, that's just common sense, isn't it? Wouldn't that be ideal to get, so even at a 20% target profit, we might say to ourselves, once I've opened this trade for $1.64, I'm going to try and close it when I can do so for $2.04, because that would represent 40 cents per share. That's a little more than 20%, and that means I probably get a 20% after my commissions. Now, the reason this is all so important, okay, these are just some target times when you might want to get into a trade. Where is our next strong level of resistance if we were to jump into a trade on these technical crossovers? Or would you consider a bounce like this? Okay, I had a little brain spasm momentarily. I'm back on track. Technical crossovers are super easy to see. We're going to go back and visit a little bit more technical review on this trade. Technical crossovers are pretty easy to see. But sometimes you're going to get a hold of a level of support, and that's just as good as a technical crossover, is it not? But whichever one of these things we're looking at, whichever one of these things we're doing, we also need to look at where is our next level of resistance. In the previous example, now we're talking about a different stock now, we're looking at a different company, but in the previous example, we determined that about $1.50, maybe $1.75 movement up would get us the 20% return. What if we had a really, really strong level of resistance that was only $1 away from where the stock is currently trading? We've got to take that into consideration. When we're putting together a bull call spread, we need to make sure that the next strong level of resistance gives the trade sufficient room to move up. The reason I took so much time explaining this, and even did it on 2 separate screens, the reason I took all the time in explaining this is because we've got to make sure that that stock can move that far before it hits a strong level of resistance. Otherwise, we're fighting odds that we can get this trade to work out for us. The odds are not in our favor that this trade is going to work. If we've got a really strong level of resistance right here, we better feel pretty confident that on this next bounce off of that support, if we're going to use that as an opportunity to get into a bull call spread, that we've got a good chance of at least moving up to where that resistance level is before things slow down. Know where your next level of resistance is and make sure you feel that the odds are in your favor of that thing getting there. Now, do you always have to go just out of the money? I'm going back to an old option chain now because I like this example. You don't have to start just out of the money. I'm going to show you a couple of variations on how to structure it. You can go just out of the money, or if the stock is trading currently really close to a strike price that is barely in the money, that might be the more advantageous place for you to jump in the trade than to going just out of the money. That's okay. Look at the numbers, look at the spread, look at the cost basis. Make sure you're comfortable with your maximum risk. Make sure you like the maximum reward and that it's still high enough to satisfy you. And make sure on your crossovers, you've got that level of resistance that's far enough away for the stock to move. So if we're starting this one, if the stock is currently trading at $107.50 and we've got a 105 strike price option, that's okay. Do we have enough room for the stock to move up before it hits that strong level of resistance and give us our maximum chance of still being profitable in the trade? If we start a little farther out of the money, how comfortable do we feel that it can move up far enough for us to get the profit that we want? We can start the whole thing a little farther out of the money if we're looking at those levels of resistance and saying, you know, this thing can go quite a ways, and I get more advantageous numbers by starting a little bit farther out of the money. A little bit in, a little bit out of the money doesn't make a big, huge difference. In this case, our maximum potential profit is 163%. The third rule that I have for bull call spreads is try really hard to get a maximum return, a maximum possible return of 100% or more. If my maximum return is 100%, how much more confident am I that I can get 20% or 25%? Versus if my maximum return, if the maximum return that I could possibly get on a trade is 50%, how confident am I that I'm going to get 25%? Let me say this in a way that a lot of times I say something and then I think of a better way to say it. And I'm trying to say this in a way that makes it the easiest possible way to understand. If I want to get a 25% return on my investment, are my chances of getting that 25% better if my maximum percent return is 50% or if my maximum percent return is 100%? Obviously, I've got better chance if my maximum return is 100%. Now, when we are choosing what expiration date, I mentioned to you in the very beginning of this that typically a bull call spread is structured 45 to 90 days out in expiration. I'm going to tell you why now. One of the things that gets people in trouble with bull call spreads is not giving themselves enough time to adjust the trade. Okay, our next class is going to talk about adjustments, but I need to set the stage a little bit. This is the little teaser for the next class. When you structure a bull call spread, look at the month you're structuring the trade in, look at the nearest term option expiration, monthly. Okay, now for just a moment, I want you for just a moment to forget about weekly options. I know they're there, we use them, we take advantage of them when we can. We're not afraid of weekly options, but I want you to focus in for just a moment on the monthly option expiration dates. Look at the nearest monthly option expiration date to the day you're thinking about opening this trade, and look at the expiration date that fits the criteria of 45 to 90 days out in expiration, and there should always be at least one monthly expiration date that exists in between there. If you're out 45 days or more in time, there should be at least one that exists in between. Why is that important? I never want to open, I could look at this and say, you know what, this is close to 45 days. Hey, Jeffrey, this is only 5 or 6 days away from 45 days. And on a lot of the other trades we do with our long puts and with our short calls, you know, we've got this general rule about 60 or 90 days out. But if we're really close to that, it still sort of fits. Why couldn't I do this one if it's that close to 45 days out? Because there does not exist between the most current upcoming monthly expiration date and the one that you're considering for the trade. If you chose the August one, there is not a monthly one in between. There needs to be at least one monthly option in between the most current upcoming one and the one that you would consider opening your trade at. I'm not going to elaborate more on this right now because I'm going to talk a lot more about this when we teach you how to adjust the trade in the next class. Because of the deltas, and because of the fact that the short call is going to increase in value with the long call, we talked about this a little bit at the beginning, somewhere between 15 to 30% return on investment is usually going to be ideal. Remember, we want to get this 15, 20, 25%. We'd like to get it in 2 to 3 weeks. We're looking for the big, fast movement on these options by being in the trade for 2 to 3 weeks or less. When we are in a debit spread, time is always our enemy. When the enemy is 6 months away, it's not as big a deal. When the enemy is 15 days away, it's a bigger deal. Think about if you were fighting a battle and your enemy is 6 or 7 states away. Okay, think about that. Your enemy is 6 or 7 states away, and they've got to get through a whole bunch of states before they're going to be able to fight you. It's not as big a deal as when they're in the next county, and that's only 10 miles down the road, and now it's a bigger deal. They're still your enemy. Time decay is your enemy on debit spreads. It works against you. Not as big a deal when it's way out there, 60, 80, 90 days away. When it's 15, 20 days away, it's a bigger deal when you're in a debit spread. A question came in, and like I said, I encourage the questions in this. Question came in, why use a debit spread versus a credit spread? I'm going to, when we do the adjustment class following this one, I don't want to ignore that question, but it might be a better question for the next class. But I'm going to answer the question anyways. Debit spreads, number one, are easier to adjust. Your question is, why use debit spread instead of a credit spread? Debit spreads 100% of the time are easier to adjust than credit spreads. And debit spreads are most of the time have a higher potential profit. Not always, but most of the time, they have a greater potential profit. Okay? That's why you would use debit spreads instead of credit spreads. But when we teach the credit spreads, we'll talk about the ideal circumstances to use them. If you're looking for a variation to a bull call spread, if you're looking to be a little tiny bit in the money with your long call, a little farther out of the money with your long call, just keep in mind, you want to have that good profit to loss ratio. You want there to be a possible maximum return of 100% or greater. You want there to be 100% or greater maximum ROI. And if you can fulfill that, being a little farther out of the money or starting with your long option just barely in the money, that's absolutely fine. There's no reason why you shouldn't do that. Keep a close eye on that next level of resistance and make sure you feel confident that you can get to that next level of resistance. Just as a review, rule number one, don't be in a bull call spread through an earnings. Make sure that resistance level gives you sufficient room for the trade to move. Get that 100% or higher max return and have at least one monthly option expiration date between the most current upcoming monthly option expiration date and the one that you're looking at for your trade. Make sure there's one in between. That'll tell you you're far enough out in time. And starting far enough out in time without being too far out in time is really the key to adjusting bull call spreads. When a stock has an expectation for a bullish move, the bull call spread can be used to take advantage of this with less risk than simply buying long calls or buying stock. It works best when there's not a major event like an earnings that takes place between the time the trade is open and I need to change this. Between the time the trade is open and the time we expect to exit the trade. Oftentimes your expiration date is going to be out past the next earnings report, even if all the other circumstances are ideal. But you need to not have an earnings event between the time you enter and the time you're expecting to exit the trade. 15 to 30%, we've talked a lot about that. We would like to be in this trade 2 to 3 weeks. Not more than 6 weeks in a worst case scenario. And if we're in the trade for more than 6 weeks, I guarantee we will have made an adjustment to the trade. That wraps up our bull call spread. Thank you for joining us and thank you for some good questions. And next is adjusting the bull call spread. Thanks everyone. Bye-bye.